Trade entries are a much talked about trading topic, and for really good reason. A trade entry close to a turning point gives a really good risk to reward ratio, while one that requires confirmation can lessen the ratio and decrease your position sizing. The problem is that oftentimes it's an area of interest that you're looking at for your trade entry and really not an exact market price. It's an area where you expect a change of state in the instrument, and perhaps just getting the trade on is the right thing to do. So if we break a trade entry into two classifications, we get entry with a confirmation and entry when price is in the zone, including a pattern zone. A trade entry with confirmation is simply having a signal once price hits your zone of interest and that price momentum is turning in your favor. If price is in your zone, you simply enter the position, set your stop, and let the market work itself out. So is trade confirmation a good thing? At the point of confirmation, all that's really occurring is a sign that your trade direction is currently the favored direction. It certainly does not mean the trade is going to work out to target, as we have seen price head in your direction and in the end stop you right out. So what confirmation for your trade entry can do is keep you out of emotional trading, where your fear of missing out on a move has you buying or selling after a sustained run in price in either direction. So let's take a good look at a simple and popular trade confirmation technique. The left portion of the green box shows a consolidation pattern that supported price, and eventually it gave way to sellers. Price retraced back into the area, and we expect sellers to once again return and drive for the price lower. Now, we knew where our stop would go long before price returned to the area. And to avoid a failure test of the highs of the previous area, we're going to keep our stop out of the line of fire. Too tight of a stop can have consequences, as I laid out in the post Forex Swing Trade Error. So our entry is simple. When price hits our zone, we sell stop the first candle that puts in a lower low. Now, one important note is that I've never tested the validity of a simple break of the lower high of a candle in terms of increasing the odds of a trade. Now, it may have an edge in the right context, such as in the image displayed or from a lower time frame structure, and that's something you're really going to want to test out for yourself. Now, the set and forget trade entry, perhaps this appeals more to swing traders, and that's where you have defined an area and you simply place your buy or sell order to be executed when price enters your zone. It can be risky, but again, context plays a role in virtually every aspect of trading. Now, I've taken quite a fair number of no confirmation trades over the years, and they certainly do allow a larger position size due to the smaller distance between your entry and your stop. Now, this is the same chart. However, I've defined not only the range before the breakout, but a small pullback inside of the range to be used as the entry price for a set and forget style of entry. Now, again, the stop is placed far enough away to allow for tests of the highs without stopping the trade out before it finds its legs. And as with all trades, your money management will make or break your overall success, so keep in mind your risk every single time that you place a trade. Now, I'm going to admit that trading without confirmation is not for everyone. And quite frankly, it does take a lot of variables in my favor to non-confirm a trade entry and opt for a trigger of some sort to get into the trade. From my experience, most traders I've spoken to will want to see some shift in the state of the market, such as a structure break, to get themselves into the trade. Now, this chart here is a 4-hour chart giving an X-ray into a daily pullback in the context of an uptrend. Price is broken out of a resistance level and was in the middle of a retest. Now, you're able to picture a two-stage pullback from the daily chart, but the 4-hour gives a better view. Number one, the red lines show the measured move from the first swing and then it's copied to the second swing, and this is called a complex pullback. Number two, a dashed black line shows the termination of the measured move. 3, the blue lines are trend channels. Now remember, context matters. Daily uptrend and pullback, complex correction, a retest of previous resistance, and defined trend channel. The yellow boxes highlight several areas where entries can be taken. Now, this example is a recent move in the euro-US dollar, and while it's hindsight, it's the only way to explain the concepts. But that said, many of the posts of actual trading that I've made have shown these exact types of entries. A, this range is the completion of the measured part of the pullback. While not a breakout trader by nature, in these contexts, these structure breaks make good entries when price breaks the high. It does not break in this instance and it heads lower. Note, while the red candle rejection at the bottom trend line may look tempting, for myself, this is not what I want to see in a failure test, so while it does work out, it's not an entry in my books. B, after the complex completion and a rejection at the demand line, price forms a range, and once again, a break out of the structure, it's a good entry. C, A price consolidation at the highs of a thrusting move are often a good entry area, taking context into consideration. Now, once you recognize a trend continuation pattern is in play, look for structures inside the pullbacks to help you get into the move. Now, I find complex pullbacks to be a safer bet because more often than not, if price continues past that second swing, the upside momentum does not look too favorable and it may be time to shift gears. So which entry do you choose? All you can be given is examples, but in the end, what matters is what you are going to do. The more you need to see to get into a trade can often lead to a smaller position size as price pulls away from your potential stop area. Structure breaks on lower time frames are often great doorways into a trade. The key is not to set your stop too close so the slight adverse movement of price does not stop you out. Setting and forgetting in the right context can also be a good play depending on several factors such as trend, the probability of flow at your zone, and how you can handle having an untended order in the market. In the end though, having the mantra set up plus trigger equals trade may be the best for the vast majority of traders for most of their trades. There is something to be said to having a hands-on approach when risking money is the name of the game.